In her book, The 7 Signs of Ethical Collapse, Marianne Jennings analyzes the indicators of possible ethical collapse in companies and provides advice on how to avoid impending disaster. Ethical collapse rarely happens suddenly. It occurs gradually as organizations drift away from basic principles of right and wrong, often while appearing successful on the surface. In this video, we'll look at the 7 warning signs that commonly appear before major corporate scandals, especially those involving accounting failures. Ethical collapse is not about one bad decision or one unethical employee. It's about systems, culture, and leadership gradually normalizing behavior that would once have been unacceptable. Accountants and auditors can often see these warning signs early. Marianne Jennings explains ethical collapse might occur in accounting and financial reporting, but that doesn't necessarily mean that companies are doing illegal things. He points out that not all companies that have drifted ethically have violated any laws. In her book, Marianne Jennings lists the following as indicators, but not proof, that ethical collapse may be occurring. Pressure to maintain numbers, fear and silence, inexperienced or overawed leadership, weak board of directors, conflicts of interest overlooked or unaddressed, innovation like no other company, and that rationalization that goodness in some areas atoned for evil in others. We previously learned that fraud can occur when 3 situations are present: situational pressure, perceived opportunity, and rationalization. These 7 signs of ethical collapse fit into these 3 categories. Pressure to maintain numbers, fear and silence, bigger than life CEO, and innovation like no other company fits into the situational pressure. Whereas the weak board of directors, conflicts of interest overlooked or unaddressed fit into the perceived opportunity category. They prevent the fraud from being detected. The third category of rationalization is the 7th sign of goodness in some areas, atoned for evil in others. Remember, these signs rarely appear alone. Ethical collapse occurs when multiple signs reinforce each other, making misconduct easier and resistance harder. Looking back, ethical collapse often seems obvious. All the signs were there. For instance, unreasonable pressure to meet numbers is one of the most common reasons of accounting scandals. When the company seems to only focus on financial metrics, ethics may be viewed as obstacles rather than core responsibilities. In some companies, executives are chosen precisely because they're unlikely to challenge authority, and inexperience can be framed as innovation while dissent is labeled negativity. This dynamic is especially dangerous for accounting and finance roles that require independent judgment. The challenge for accountants and auditors is recognizing these signs before the collapse becomes public. That requires professional skepticism and ethical courage. Accountants are often among the first to notice pressure, rationalization, and control breakdowns. Ethical responsibility means recognizing when these warning signs appear and understanding that silence is itself a decision. I hope you enjoyed this overview of the book, The 7 Signs of Ethical Collapse. Ethical collapse is not random. It follows recognizable patterns and warning signs. Understanding these signs helps accountants and auditors fulfill their public interest responsibility, not by being perfect, but by being aware, skeptical, and willing to speak up.